Government-backed loans. Conventional loans are the most common loan type available, and most homes are financed through uninsured or insured conventional loans. However, the government still plays a role in providing loans for property purchases. As we said earlier, government-backed loans include those loans offered by the Federal Housing Administration, the Department of Veterans Affairs, sometimes simply referred to as VA, Rural Housing Service, State of New York Mortgage Association. Let's take a detailed look at each of these government agencies and the lending programs they sponsor. Federal Housing Administration loans. The Federal Housing Administration was established in 1934 during the Great Depression to stimulate the housing market in the United States. The FHA provides low down payment FHA mortgage loans to qualified buyers. The Department of Housing and Urban Development oversees the FHA. The loans FHA provides are high loan-to-value ratio loans, so FHA insures the loans in order to make them available to higher-risk individuals. Important note: FHA does not build homes or loan money directly. They insure loans made by approved lending institutions, including qualified mortgage companies, savings and loan associations and commercial banks. FHA-insured loans protect lenders against any loss they would suffer from a borrower's default. The following items are important to know about FHA loans. FHA loans can be either fixed-rate 10 to 30-year loans or 1-year adjustable loans. The maximum loan term is 30 years or 75% of the remaining economic life of the property, whichever is less. Down payments are low. However, the borrower must have cash for a down payment and closing costs. These items cannot be added to the sales price and become part of the loan repayment. The maximum loan fee is 1% of the loan amount and is typically paid by the buyer. Federal Housing Administration loans. Here are additional facts to know about FHA loans. As of 2006, the borrower must pay 2 insurance premiums. The first is the upfront mortgage insurance premium, which is a percentage of the loan amount. The borrower can pay this one-time premium at closing, or the charge could be financed with the loan. This premium could be paid by some other party, such as the seller. The second premium, called mutual mortgage insurance, is a monthly premium that is paid with the monthly principal, interest, taxes and insurance payment. This is often referred to as PD plus ME. ME premiums may be dropped when the remaining loan balance is 80% loan-to-value ratio or less. FHA requires that the monthly amounts the borrower pays toward taxes, insurance and ME be deposited into an escrow or impound account. The lender can charge points and either the borrower or the seller can pay them. Note: both interest rates and discount points are fully negotiable between borrower and lender. Loans are assumable, but the rules for assumptions vary depending upon when the loan originated, the type of property, and the specific FHA program under which the original loan was given. Federal Housing Administration loans. More facts about FHA loans include: the mortgaged real estate must be appraised by an approved FHA appraiser. These appraisals are called conditional commitments and are good for 6 months on existing property and 1 year on new construction. There is no maximum on what the purchase price of the property can be. The borrower can pay more than the appraisal, but the loan will be based on the appraisal amount. The property must meet the FHA standards for type and construction. FHA also has standards about the quality of the neighborhood. These loans are available for 1 to 4 family residences and some condominium units. The borrower must occupy the property. FHA requires evidence from a recognized structural pest inspection company that an existing property has no pest infestation. FHA loans are also available to help residents or investors repair or rehabilitate single-family properties. There are no prepayment penalties on FHA loans on 1 to 4 family residences. However, the borrower must give 30 days written notice to pay a loan in full before it is due. There is no due on sale clause. Original terms of the loan stay the same and cannot change because of a sale. Department of Veterans Affairs loans. In an effort to make it possible for veterans returning from World War II to purchase a home, the Veterans Administration, now the Department of Veterans Affairs, offered the opportunity for veterans to purchase a home with no money down. In order to make this VA mortgage loan acceptable to lenders, the VA agreed to guarantee the top portion of the loan. Since lenders were now protected in the event of a default by the borrower, lenders agreed to loan 4 times the current VA entitlement. The basic entitlement of a VA loan is $36,000. although some loans are eligible for up to $60,000 if they are over $144,000. The VA guaranteed amount is calculated as 25% of the home loan amount up to $104,250. The VA limits the maximum amount of a loan with no down payment to $417,000. Most lenders require that a combination of the guarantee entitlement and any cash down payment must equal at least 25% of the reasonable value or sales price of the property, whichever is less. Note, in certain cases, a veteran may have a partial entitlement if the amount to be guaranteed has increased since the first time the veteran used his eligibility. Department of Veterans Affairs Loans Veteran Eligibility. The veteran must provide a certificate of eligibility showing the amount of entitlement available. The entitlement is the maximum number of dollars that VA will pay if the lender suffers a loss. The following veterans are eligible, based on time spent in the service. Active duty veterans discharged during World War II or later, without the status of dishonorable. Active duty veterans with at least 90 consecutive days of service during major conflict. Peacetime veterans and active duty personnel with at least 180 days of consecutive service. Enlisted veterans whose service began after 1980 or officers whose service began after 1981 and who have served at least 2 years. National Guard and selected reserve members who have served for 6 years. Certain unmarried spouses of veterans who were deemed missing in action or prisoners of war, who died in action or died due to a service-related accident, or who have served as a U.S. public health officer may also be eligible. The veteran must plan to occupy the property. In order to use both incomes for a couple to qualify, they must either be married or both have VA eligibility. Otherwise, VA will only guarantee half of the amount of entitlement. Department of Veterans Affairs Loans. A veteran may use VA guaranteed financing for any of the following situations. To buy a home. To buy a townhouse or condominium unit in a project that has been approved by VA. To build a home. To repair, alter or improve a home. To simultaneously purchase and improve a home. To improve a home through installment of a solar heating and/or cooling system or other energy-efficient improvements. To refinance an existing home loan. To refinance an existing VA loan to reduce the interest rate and add energy efficiency improvements. To buy a manufactured home and/or lot. To buy and improve a lot on which to place a manufactured home which you already own and occupy. To refinance a manufactured home loan in order to acquire a lot. Department of Veterans Affairs Loans. These are some other rules that apply to VA guaranteed loans. The maximum VA home loan term is 30 years and 32 days. However, the loan term cannot exceed the remaining economic life of the property. The VA does not require a down payment. There is no maximum loan amount. However, as we mentioned earlier, VA guarantees only a portion of the loan. So, most lenders will limit the amount they are willing to lend on VA loans. Interest rate and discount points are negotiable between the lender and the veteran borrower. The loan origination fee cannot exceed 1% of the loan amount. VA requires only monthly principal and interest payments. Even though they do not require taxes and insurance to be included, VA recommends that they be included. The loan may be prepaid without penalty. VA requires a structural pest report from a recognized inspection company. If repairs are indicated, the work must be done and certified by both the veteran and an inspector. Funding fee. The funding fee is a percentage of the loan amount charged for the privilege of obtaining a VA loan. This fund is used for administrative costs and to offset losses incurred in cases of default by the borrower. It is very similar in function to VA mortgage insurance premiums. The veteran can pay the fee upfront or choose to finance it as part of the loan, as long as it does not increase the loan amount beyond the maximum allowed. If so, it must be paid separately by either the veteran or the seller. Department of Veterans Affairs Loans Funding Fee Exemptions. The following persons are exempt from paying the funding fee. Veterans receiving VA compensation for service-connected disabilities. Veterans who would be entitled to receive compensation for service-connected disabilities if they did not receive retirement pay. Surviving spouses of veterans who died in service or from service-connected disabilities, whether or not such surviving spouses are veterans with their own entitlement, and whether or not they are using their own entitlement on the loan. Please note that the VA has the final say on who is exempt. Certificate of Reasonable Value. An approved VA appraiser must issue a certificate of reasonable value showing the value of the property to be equal to or greater than the sales price. The CRV is valid for 6 months on existing property and 12 months on new construction. The VA will never issue a certificate that shows the value to be greater than the sales price. For example, if a home is selling for $300,000 and the appraisal comes in at $325,000, the CRV will be $300,000. On the other hand, if the sales price is $300,000 and the appraisal is $275,000, the CRV will be $275,000. The veteran may proceed with the purchase if the sales price exceeds the CRV, but he or she will be required to pay the difference in cash. The source of the cash must be approved by the VA. If the CRV is not equal to or greater than the sales price, the veteran may withdraw from the contract. Rural Housing Service. Rural Housing Service was created in 1994 as a result of the Department of Agriculture Reorganization Act to meet housing and community development needs of rural America. The USDA Rural Housing Service has various programs available to aid low to moderate income rural residents to purchase, construct, repair, or relocate a dwelling and related facilities. Qualified homebuyers can get loans with minimal closing costs and no down payment. Direct Loan Program. Individuals or families receive direct financial assistance from the Rural Housing Service in the form of a home loan at an affordable interest rate. These loans may be made to eligible applicants to buy, build, repair, renovate, or relocate homes, to provide related facilities, or to refinance home debts under certain conditions. Applicants for direct loans from RHS must have very low or low incomes. Even though there is no required down payment, families must be able to afford the mortgage payments, including taxes and insurance. In addition, applicants must be without adequate housing and be unable to obtain credit elsewhere, yet have acceptable credit histories. Loans are typically made for up to 33 years. Rural Housing Service. Guaranteed Loan Program. The Rural Housing Service guarantees loans made by private sector lenders. This means that if the individual borrower defaults on the loan, RHS will pay the private financier for the loan. The purpose of this loan program is to enable eligible low and moderate income rural residents to acquire modestly priced housing for their own use as a primary residence. The program is available for the purchase and repair of existing and newly constructed homes. SONYMA. SONYMA provides low interest rate mortgages to low and moderate income families in the state of New York. Using the proceeds of tax-exempt mortgage revenue bonds, the Low Interest Rate Mortgage Program offers below-market interest rate mortgages to low and moderate-income households who must be first-time homebuyers except in target areas. SONYMA mortgages are insured by private mortgage insurance. SONYMA also gives special incentives to prospective homebuyers interested in purchasing a home in a federally designated target area, which is an area considered to be economically distressed. The special incentives for federally designated target areas are: the applicant does not have to be a first-time homebuyer. The applicant can make more income and purchase more homes since the household income and home purchase price limits are higher. The applicant can purchase a two-family home that is newly constructed or an existing home that is less than 5 years old. Most SONYMA mortgages are set at a fixed rate that is generally 2-3 percentage points lower than conventional mortgage rates. Check your understanding. Print this screen, answer the questions and then advance to the next screen to see the answers. 1. FHA and VA loans differ from conventional loans in what important way? 2. What kind of insurance does FHA require borrowers to pay? 3. What is a certificate of reasonable value and what is it used for? 4. What kinds of loans does SONYMA provide? Check your understanding. Answers 1. FHA and VA loans differ from conventional loans in what important way? FHA and VA do not loan funds directly. FHA insures loans and VA guarantees loans, but the loans themselves are made by approved, qualified lenders. 2. What kind of insurance does FHA require borrowers to pay? As of 2006, the borrower must pay 2 insurance premiums. The first is the upfront mortgage insurance premium, which is a percentage of the loan amount. The borrower can pay this one-time premium at closing, or the charge could be financed with the loan. The second premium, called mutual mortgage insurance, is a monthly premium that is paid with the monthly principal, interest, taxes and insurance payment. ME premiums may be dropped when the remaining loan balance is 80% loan-to-value ratio or less. 3. What is a certificate of reasonable value and what is it used for? A certificate of reasonable value shows the value of a property in relation to its sales price. It is issued by an approved VA appraiser when a veteran is seeking a VA loan. 4. What kinds of loans does SONYMA provide? SONYMA offers below-market interest rate mortgages to low and moderate-income households who must be first-time homebuyers except in target areas. Summary review. This concludes Chapter 15. Below is a summary which you can review before taking your quiz. A mortgage is a financing instrument that creates a lien against a property. A promissory note establishes legal evidence of the debt incurred. A mortgage always needs a note to be legally valid. A monthly mortgage payment is generally made up of 4 parts: principal, interest, taxes and insurance. Lenders refer to this as PD. If the purchaser defaults, the lender has the right to bring legal action through the courts to satisfy the debt. This is done through foreclosure, the process that leads up to selling the property that was pledged to secure the debt. In order to increase their investment, lenders often charge other fees when the borrower gets the loan. These fees are loan origination fee and points or discount points. If a grantee takes title to a property subject to a mortgage, that person is not personally liable to the lender for payment of the mortgage. The seller is still responsible for making the mortgage payments. A mortgage assumption is the act of acquiring title to a property that already has an existing mortgage and agreeing to be personally liable for the terms and conditions of the mortgage, including the payments. When a mortgage is paid in full, the lender will issue a certificate called a satisfaction of mortgage. Summary review. Summary. Several types of repayment plans exist. The most common are: straight, monthly payments are allocated only to interest. Amortized, a borrower makes a periodic payment of principal plus interest. Balloon payment, a loan that has one large final payment due when the loan matures. Adjustable rate, interest rates change periodically, usually every 1, 3 or 5 years. There are basically 2 categories of loans available to buyers in the marketplace: conventional loans and government-backed loans. The conventional mortgage is the most common type of loan and is generally viewed as the most secure. Most conventional loans require the borrower to make a down payment of 20% or more, making the loan 80% or less of the property's sale price. Conventional loans are typically uninsured. Most conventional loans have traditionally been designed as fixed-rate loans. The most common fixed-rate loans are 30-year mortgages, because the payment is stable and there is always the opportunity to pay the balance down or to refinance for a better rate at a later date. A borrower can get a conventional loan with a lower down payment by insuring the loan through a private mortgage insurance program. The PMI payments will terminate once the loan has been repaid to a certain level. Summary review. Summary. For buyers who may not be able to qualify for a standard fixed-rate mortgage, there are other options for conventional loans. With a graduated payment mortgage, the monthly payment for principal and interest gradually increases by a certain percentage each year for a certain number of years, and then it levels off for the remaining term of the mortgage. A pledged account mortgage is a type of graduated payment mortgage under which the owner-borrower contributes a sum of money into an account that is pledged to the lender. In a buy-down, the lump sum payment that is made to the lender at closing usually comes from a builder as an incentive to the buyer or from a family member trying to help out. An open-end loan is an expandable loan which gives a borrower a limit up to which he or she may borrow. A blanket mortgage loan covers more than one piece of property. Land developers commonly use blanket mortgages when they buy a plot of land and divide it into many separate lots. A wraparound mortgage allows a borrower who has an existing loan to get another loan from a second lender without paying off the first loan. Summary review. Summary. A bridge loan is a short-term loan that covers the period between the end of one loan and the beginning of another. A purchase money mortgage is most commonly a technique in which the buyer borrows from the seller in addition to the lender. Lenders give construction mortgages to finance the construction of improvements to property, such as homes, apartments and office buildings. With a home equity loan, owners have the ability to borrow against the equity they have built up in their home. A package mortgage is one that includes all the personal property and appliances that are installed on the property. A reverse annuity mortgage is one in which the lender is making payments to the borrower. A shared equity mortgage is a form of participation mortgage in which the lender shares in the appreciation of a mortgaged property if and when the property sells. Summary review. Summary government-backed loans include those loans offered by the Federal Housing Administration, the Department of Veterans Affairs, sometimes simply referred to as VA, Rural Housing Service. State of New York Mortgage Association FHA does not build homes or loan money directly. They insure loans made by approved lending institutions, including qualified mortgage companies, savings and loan associations and commercial banks. FHA-insured loans protect lenders against any loss they would suffer from a borrower's default. The Department of Veterans Affairs offers the opportunity for veterans to purchase a home with no money down. In order to make this VA mortgage loan acceptable to lenders, the VA agreed to guarantee the top portion of the loan. The USDA Rural Housing Service has various programs available to aid low to moderate income rural residents to purchase, construct, repair, or relocate a dwelling and related facilities. Qualified homebuyers can get loans with minimal closing costs and no down payment. The SONYMA program offers below-market interest rate mortgages to low and moderate-income households who must be first-time homebuyers except in target areas. SONYMA mortgages are insured by private mortgage insurance. Click here if you would like to open this summary as a PDF, which you can then print or save to your device. Chapter 15 Summary Chapter Conclusion. In this chapter, we have discussed definition of a mortgage, duties of the mortgagor, types of mortgages, specific types of loans and their payment plans, government-backed loans. In the next chapter, we'll continue our discussion of real estate finance by explaining secondary markets, criteria for getting a loan, and predatory lending. Now it's time for your chapter quiz. Good luck! 1 of 24. Which of the following does not meet the criteria for a VA loan? To make a down payment on a motorhome. 2 of 24. Which mortgage clause requires the borrower to maintain the physical condition of the property? Preservation and maintenance of property. 3 of 24. Steve has an existing loan with Sunray Bank and has applied for a second loan. He does not have to pay off his existing mortgage in order to qualify. What type of loan is Steve getting? Wraparound loan. 4 of 24. The loan-to-value limit set for conventional loans on single-family residences is 85%. 5 of 24. A measure of economic conditions is an index. 6 of 24. Which of the following does not happen as part of a foreclosure by action in equity and sale? The mortgagor sues the lender. 7 of 24. When might a lender be willing to release the original seller from liability in a mortgage assumption? All of the above. 8 of 24. A subdivision developer most likely would apply for what type of loan? Blanket loan. 9 of 24. PMI loans made after July 1999 require that the loan must be released when the loan-to-value ratio reaches 78%. 10 of 24. Government-backed loans are not offered by HUD. 11 of 24. In which type of loan is the payment allocated only to interest? Term mortgage. 12 of 24. What is added to the current index to set the interest rate? Margin. 13 of 24. What type of loan is often used when a seller will not accept a property sale contingency? Bridge loan. 14 of 24. What is the interest rate on an ARM tied to? Index. 15 of 24. Typically, the interest rate on an ARM is based in part on an index. 16 of 24. In an effort to make it possible for veterans returning from World War II to purchase a home, the Veterans Administration offered the opportunity for veterans to purchase a home with no money down. 17 of 24. How does a borrower use private mortgage insurance? A borrower can get a conventional loan with a lower down payment by insuring the loan through private mortgage insurance. 18 of 24. What is the process whereby the property's legal title is transferred to the lender? Deed in lieu of foreclosure. 19 of 24. Seller James has taken back $20,000 as a second mortgage so buyer Carl can qualify to buy the property. The $20,000 is what type of mortgage? Purchase money mortgage. 20 of 24. Which repayment plan is known as an interest-only loan? Straight. 21 of 24. Which repayment plan is a partially amortized loan? Balloon. 22 of 24. Which repayment plan is usually fixed interest, long-term loans? Amortized. 23 of 24. What is the lender's right of assignment? The lender may sell the mortgage. 24 of 24. What type of document does a homeowner sign when agreeing to a mortgage? Promissory note.